Welcome back to Boni's Life, where we cut through the noise and deliver the unvarnished truth about the global economy and the crypto markets. I am your host, Boni, and today we are diving deep into a market that is currently testing the nerves of every trader out there. We are looking at a Bitcoin price that has just broken through the $78,000 resistance level, hitting $79,214, driven by a massive short squeeze and shifting geopolitical winds. Whether you are a short-term scalper looking at the 15-minute and 1-hour charts, a mid-term swing trader analyzing the daily and weekly timeframes, or a long-term investor focused on the monthly macro picture, the data we are unpacking today is critical for your survival and success in this market. We will analyze the volume, total market capitalization, the fear and greed index, open interest, and the staggering liquidations that have defined the past 24 hours. We will break down every major technical indicator, from RSI to Bollinger bands to Fibonacci retracements, and we will project where this market is heading using both bullish and bearish scenarios. We will also provide you with the exact technical setups and triggers you need for your next trades, complete with entry points, take profit targets, and stop losses. And we are going to cover the global events that are shaping this market in ways that most people are not even aware of. So if you have not already, hit that subscribe button, turn on the notifications, and let us get into it. Let us start by looking at the macroeconomic picture and the total crypto market capitalization. At the end of the first quarter of 2026, we saw a significant correction, with the total market cap falling by 20.4% to $2.4 trillion, according to CoinGecko's Q1 2026 industry report. This left the asset class roughly 45% below its October 2025 peak. However, the market has shown incredible resilience. As of today, April 22nd, 2026, the total market cap has rebounded to approximately $2.7 trillion. Bitcoin's dominance remains strong at roughly 60%, underscoring its position as the undisputed heavyweight of the digital asset space. The 24-hour average crypto trading volume has jumped by nearly $10 billion to hover around $112.2 billion. This surge in volume is a clear indicator that capital is flowing back into the market, driven by institutional accumulation and a sudden shift in global risk sentiment. Now, for those of you who are new to this, volume is one of the most important indicators we look at because it tells us the conviction behind price movements. High volume on an upward move means the rally has legs. Low volume means it could be a trap. And right now, the volume is screaming that this move is real. The psychological state of the market is perfectly captured by the fear and greed index. And this is where things get really interesting. Just last month, the index was sitting at an abysmal 8, indicating extreme fear. That is as close to capitulation as you can get without the market completely collapsing. Last week, it was at 23. Today, it has recovered slightly to 32, which is still in the fear territory but shows a clear upward trajectory. This transition from extreme fear to moderate fear is historically a contrarian buy signal. When the masses are fearful, the smart money is accumulating. And we are seeing this play out in real time. Whale accumulation has hit its highest level since 2013, with over 270,000 Bitcoin scooped up in the last 30 days, according to on-chain data from Glassnode and CryptoQuant. That is not retail buying, folks. That is institutional capital and high net worth individuals positioning themselves for what they believe is the next leg up. Furthermore, exchange reserves have plummeted to a 7-year low of 2.21 million Bitcoin, creating a massive supply squeeze that is fundamentally supporting the current price action. When Bitcoin leaves exchanges, it means holders are moving their coins to cold storage, which signals long-term conviction and reduces the available supply for selling. This is a fundamentally bullish setup that most mainstream media outlets are completely ignoring. And here is something else the mainstream is not telling you. The spot Bitcoin ETF inflows have been consistently positive, with $1.54 billion flowing in monthly, led by BlackRock's IBIT fund. This institutional demand, combined with the supply squeeze from exchange withdrawals, is creating a pressure cooker that could explode to the upside at any moment. Now let us examine the derivatives market, specifically open interest and liquidations, which have been the primary drivers of the recent price explosion. Total crypto futures open interest has increased by over 4% to $126 billion in just 24 hours, according to data from CoinGlass. What is truly staggering is the liquidation data. We have witnessed a massive short squeeze, with a 4,362% liquidation imbalance. Let me break that down for the beginners. Out of $34.23 million in total Bitcoin liquidations within a single hour, a massive $33.46 million came from short positions. That means 97.7% of all losses were borne by bears betting against the rally. In the past 24 hours, total market liquidations reached nearly $400 million. The funding rates, which had been negative for 46 consecutive days, the longest streak since the FTX collapse in late 2022, have finally flipped positive. For those who are new to this, funding rates are periodic payments between long and short traders in perpetual futures markets. Negative funding means shorts are paying longs, which indicates extreme bearish sentiment. When funding flips positive after such a prolonged negative streak, it signals a fundamental shift in market positioning. The bears who were aggressively pressing the market and paying a premium to maintain short exposure have been forcibly ejected, clearing the path for upward momentum. This is not just a technical event, it is a structural reset of the derivatives market. And for the advanced traders among you, keep an eye on the options market as well. The derivative options expiry on April 24th has $8.07 billion in notional value, with 56,300 calls versus 49,540 puts. That call-to-put ratio tells you that the options market is positioning for upside, which aligns with the short squeeze narrative we are seeing in the futures market. To understand where we are going, we must analyze the technical setups and the key indicators that are flashing right now. Bitcoin has broken above the 50-day and 100-day exponential moving averages, signaling that the bulls are regaining control. The Relative Strength Index, or RSI, is currently sitting at 64.98. For the beginners, the RSI measures the speed and magnitude of recent price changes to evaluate whether an asset is overbought or oversold. A reading above 70 is overbought, below 30 is oversold, and our current reading of 64.98 is a bullish reading that indicates positive momentum without being overbought, meaning there is still room to run. The Bollinger Bands have narrowed to a historically tight range, which is a classic precursor to explosive volatility. Think of Bollinger Bands as a rubber band being stretched. The tighter they get, the more violent the snap when they release. We have just witnessed a breakout above the midline of the weekly Bollinger Bands, which according to technical analysts at FOMC and Daily Forex, opens the path toward $96,600. However, we must respect the resistance levels. The immediate ceiling is the Fibonacci 0.5 level at $78,855, which we are currently testing. A clean break and daily close above this level, and specifically above the $80,000 psychological barrier, will target the 200-day EMA at roughly $84,000. Conversely, the key support to watch is the Fibonacci 0.382 level at $74,397. Below that, the Fibonacci 0.236 level at $68,882 represents the war escalation level, and the macro floor sits at the Fibonacci 0.0 level of $59,967. The composite technical signals are showing 11 bullish, 8 neutral, and 4 bearish readings, which gives us a net bullish bias, but with significant caution warranted. We cannot analyze the crypto markets in a vacuum. Global macroeconomic and geopolitical events are heavily influencing price action, and this is where the hidden story lies. The immediate catalyst for this recent rally was President Trump's decision to indefinitely extend the US-Iran ceasefire on April 22nd. This easing of geopolitical tension sparked a relief rally across risk assets, including the Nasdaq and S&P 500, with Bitcoin showing an 85% correlation to the Nasdaq. However, the geopolitical landscape remains fraught with hidden complexities that most analysts are not discussing. Iran has reportedly demanded that ships pay tolls for accessing the Strait of Hormuz in cryptocurrency, highlighting the increasing weaponization of digital assets in global conflicts. This is a development that could have profound implications for how nation-states interact with the crypto ecosystem. Furthermore, the permanent implementation of Trump's tariffs on Mexico and the potential for EU retaliation are creating underlying inflationary pressures. The US has collected over $166 billion in tariff revenue by early 2026, and Trump's unpredictable statements have been triggering 5 to 12% Bitcoin swings. Looking ahead to the next 2 weeks, we have a gauntlet of macroeconomic data releases. On April 24th, we have the derivative options expiry with $8.07 billion in notional value. On April 29th, we have the FOMC rate decision where a rate hold is expected, but the tone of Powell's press conference will be critical. That same evening, Microsoft, Alphabet, Meta, and Amazon all report earnings. The following day, April 30th, we get the Q1 GDP advance estimate, the PCE inflation data, and the employment cost index all released simultaneously, with core PCE remaining at 2.7% above the Fed's 2% target and oil prices near $100 through much of Q1. The macroeconomic backdrop presents significant headwinds that could cap the upside if inflation proves sticky. Goldman Sachs has noted that the Iran peace talks could reshape Fed policy, while Kevin Walsh, the Fed chair nominee, has called for regime change at the Fed and eyes rate cuts, which has boosted odds for a 25 basis point cut. Now, let us get into the strategies, starting with the short-term traders, the scalpers, and day traders. The next 24 to 72 hours are critical for you. Your strategy should be a breakout play based on the geopolitical relief rally and the short squeeze momentum. The entry zone is between $76,800 and $78,000, buying the dips toward the short-term holder cost basis. The trigger for a long position is a confirmed hold above the $78,855 Fibonacci level on the 4-hour chart with increasing volume. Your first take-profit target is the $80,000 psychological resistance, followed by the $83,312 Fibonacci extension. However, you must maintain a strict stop loss at $73,500, just below the key support cluster, to protect against a sudden geopolitical escalation or a rejection at resistance. Your risk-to-reward ratio should be at minimum 1 to 2. Use the 15-minute, 1-hour, and 4-hour time frames for your analysis. Watch for volume spikes and RSI divergences on these lower time frames. The market is highly reactive right now, so tight risk management is non-negotiable. Do not over-leverage. Keep your position sizes at 1 to 2% of your total capital per trade. And here is a critical tip. Watch the derivative options expiry on April 24th. With $8.07 billion in notional value expiring, we could see significant volatility as market makers adjust their hedges. For the midterm swing traders, your focus should be on the structural shift in the market and the upcoming macroeconomic data. The negative funding rates for 46 days followed by this massive short squeeze indicate a potential trend reversal, but you need confirmation before committing significant capital. Your strategy is to accumulate on pullbacks to the 50-day moving average, currently around $70,300, and the $74,000 support level. Use the daily and weekly time frames for your analysis. You are playing the narrative of institutional accumulation, specifically the recent $2.54 billion Bitcoin purchase by Strategy, formerly MicroStrategy, which bought 34,164 Bitcoin at an average price of $74,361, their largest purchase since 2024. You are also playing the consistent inflows into the spot ETFs, which have seen $996.4 million in weekly inflows, with BlackRock's IBIT leading the charge. Your triggers will be the upcoming PCE inflation data and the FOMC tone on April 29th and 30th. If the Fed signals a higher for longer rate environment due to sticky inflation, be prepared to hedge your positions or take profits near the $84,000 200-day EMA. If the tone is dovish and keeps later 2026 cuts alive, you can hold for a push toward the $96,000 Bollinger Band target. Your stop loss should be placed below the macro floor of $68,000. Also watch for the Clarity X Senate markup in late April, which could provide regulatory clarity for digital assets and act as a positive catalyst. Strategy reports Q1 2026 earnings on May 5th, and with approximately 713,502 Bitcoin on their balance sheet, any positive guidance could further fuel institutional sentiment. For the long-term investors, the noise of the daily fluctuations should be secondary to the fundamental on-chain data, and this is where the truly compelling story lies. The fact that exchange reserves are at a 7-year low and whale accumulation is at its highest since 2013 paints an incredibly bullish long-term picture. Your strategy is dollar cost averaging, ignoring the short-term volatility caused by geopolitical headlines. Use the weekly and monthly timeframes for your perspective. The transition of Bitcoin into a sovereign reserve asset and the increasing institutional adoption are the true drivers of long-term value. Spot Bitcoin ETF inflows have reached $1.54 billion monthly, And the regulatory landscape is becoming increasingly favorable with the Genius Act for Stablecoin Oversight and the Clarity Act for broader digital asset regulation. The current price, while recovering, is still significantly below the all-time high of $126,021 reached in October 2025. Your focus should be on the macro trend, recognizing that the current supply squeeze, combined with the post-halving dynamics, we are now past the 50% mark of the current halving cycle that began in April 2024, sets the stage for a potential run toward the $120,000 mark by the end of the year, provided the global liquidity cycle reverses its current stalling trend. The base case from leading analysts is $95,000 to $120,000 by end of 2026, with a super bullish scenario of $150,000 to $250,000 if everything aligns. However, I must be balanced here. Beth Kindig has noted that global liquidity appears to be stalling, which historically has not been good for Bitcoin. And a Deutsche Bank survey found that the majority of consumers think 2026 will not be Bitcoin's comeback year. So while the on-chain data is bullish, the macro liquidity picture requires careful monitoring. In conclusion, the crypto market is at a pivotal juncture, and I want to leave you with a clear framework for navigating the next 7 days. We have witnessed a powerful short squeeze driven by geopolitical relief and extreme bearish positioning. The technicals are flashing bullish signals with the RSI at 64.98, the Bollinger Bands breaking out, and the price reclaiming key moving averages. But the macroeconomic headwinds of sticky inflation at 2.7% core PCE, stalling global liquidity, and the upcoming FOMC decision remain significant threats that could derail this rally. Here is your action plan. On April 24th, watch the IBIT options expiry with $8.07 billion in notional value. Expect volatility and potential pin risk around the max pain level. On April 29th, the FOMC decision and big tech earnings will set the tone. If Powell is hawkish, protect your positions. If dovish, prepare for a breakout. On April 30th, the triple data release of GDP, PCE, and ECI will be the most consequential morning of the quarter. Weak GDP plus hot inflation equals the worst scenario for risk assets. Strong GDP plus cooling inflation equals the best scenario. Whether you are trading the hourly charts or building a multi-year portfolio, the key is to remain objective, rely on the data, and execute your strategies with disciplined risk management. Do not get caught up in the mainstream media narratives. Look at the on-chain data, follow the money, and understand the hidden forces driving this market. The whales are accumulating, the exchanges are draining, and the bears have been liquidated. The setup is there, but the confirmation is still pending. Stay patient, stay disciplined, and let the market come to you. Remember, in this market, the informed survive and the disciplined thrive. Thank you for joining me on Boni's Life. If you found this analysis valuable, please like, share, and subscribe. Drop your thoughts in the comments below. I read every single one. Tell me, are you bullish or bearish for the next 7 days? Stay sharp, stay informed, and I will see you in the next episode.